Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host today. Today we're going to talk more on a current events matter. I want to talk about the Fed meeting today. What did the Fed do? Why did the market react like it did? And what does it mean for inflation and any other implications that sort of come up as I'm rambling along. First, the event. The Fed today, the FOMC, met and hiked the overnight interest rates 50 basis points, which was as expected, the Fed funds rate. They also announced that they are going to begin the balance sheet runoff on June 1st. And that was roughly as expected. And they in terms of how rapidly they'll run down the balance sheet, the answer is not very, but it was about what the market had expected. If anything, that was a little bit less. There were some people who thought that the Fed might immediately begin balance sheet runoff because if inflation is a big concern, you'd want to kind of do that pretty quickly. But they decided to start that next month. And they're going to start at about 1/3 speed and then ramp it up over the next couple of months after that. So again, about as expected. None of that's dramatic. And if anything, it was a little bit timid because of the rate of runoff starting next month instead of this month. And the market kind of didn't really react initially. There's no penalty to the Fed for delivering what the market was expecting. The market was expecting 50 basis points. They were expecting a beginning to the runoff. And so, you don't get any extra points for delivering 50 basis points. But it's still, you're delivering 50 basis points and you're beginning the runoff. And these were things that needed to be done. It's hard to claim that they are particularly aggressive. Now, as I said, the market didn't really react very much to that statement. It was expected. We all know that inflation is running crazy. We all know that Federal Reserve speakers have been out there and talking about 50 basis points. We know that Bullard had floated the idea of doing 75 basis points, and the market traded down aggressively. And then Loretta Mester came out the next day and said, no, we're not thinking about 75 basis points. So they had done the whole flagpole thing, and the market had told them very clearly that, no, 50 basis points is what we're ready for, and the Fed just delivered it. Not super aggressive. But then Chairman Powell took to the microphone. And, this is something that's very different from what it used to be in the Volcker days. Back in the Volcker days, he didn't have to go to the microphone. And there were a fair number of people who didn't know who Paul Volcker even was. And now, Chairman Powell can go in front of the microphone and say that he wants to speak directly to the American people, as he said today. So, it's bad enough that we have 24-hour market news television stations to give us, fast twitch reactions to things which should be 40-year investments to us. But now we have the Federal Reserve chief speaking directly to the American people. And, he said a bunch of things. One of the things he said was that we see restoring price stability is absolutely essential. So, he's clearly what he was trying to do in speaking directly to the American people. He was trying to do the old Bill Clinton feel your pain thing. Like, yes, we know inflation is really a concern, and we're going to, we're going to talk really aggressively about this. We're going to, because talk is so cheap. So we're going to we see restoring price stability is absolutely essential. Which, of course, the people listening also see it as absolutely essential because they're getting absolutely filleted by the higher prices they see all the time. But I question that statement. I don't think the Federal Reserve sees that as absolutely essential. If the Fed saw market price stability is absolutely essential, then they wouldn't have added as much to their balance sheet as they did in the first place, and they would be aggressively tearing down their balance sheet as quickly as they could and letting interest rates go where they will. But that clearly is not an absolute to them. It is one of the things that they care about, but it is certainly not the only thing that they care about, and it may not even be the most important. But it's easy to say that. And the Fed, Powell also said that the Fed's main job is price stability, and kind of downplayed that the Fed really has a whole lot to do with employment. Well, again, that's easy to say when unemployment rate is as low as it's ever been, or close to it. It would be harder to say that if the unemployment rate was 8 or 10%. So again, it's easy to talk tough when there's no one around who's challenging you. He's just saying what people kind of want to hear, sort of like any politician. Look, any politician will promise you things that don't cost them anything, and there is no cost to speaking hawkishly right now, as long as you're not too much more hawkish than what the market really has priced in. As we saw with Bullard coming out and talking about 75 basis points, the market reacting poorly. And so, the Fed wants to sort of maybe, get the market to gently go to where they want it to go so that then they can be aggressive. But I assure you that, and I'll get to this in a second, but if the market reacts very, very poorly as it did when Bullard said his thing, the Fed will just as quickly trot out somebody to calm everybody down and say, don't worry, it's not going to be that bad. So if price stability is absolutely essential, here's the question: will you keep tightening if there's a recession? And Powell's answer is, well, we have a pretty good chance of avoiding recession, which doesn't answer the question. First of all, you don't really have that good a chance of avoiding recession. I can't think of any examples in history where you had a dramatic increase in energy prices, not to mention food prices, and large increases in interest rates, which they claim they're going to do, and didn't have a recession. That would be very odd. Does the labor market look good right now? Sure, the labor market looks great right now, but a recession isn't going to happen tomorrow. But it's going to happen next year. And it's very likely that we'll have a recession in 2023. In fact, I think it would be rather remarkable if we didn't. It would be quite an accomplishment if the Fed was able to raise interest rates and drain the balance sheet, if energy prices, stayed at $110 a barrel and we didn't have a recession. That would be something special, especially as the globalization trend crumbles and we do less business globally. Powell says they're highly attentive to inflation risks, and he doesn't see a wage price spiral. Of course, if you did see a wage price spiral, would you be more aggressive than you are? Would you tighten if stocks are down 20%? These are what we want to know. I mean, it's almost a Dr. Seuss kind of thing, right? Would you tighten in a slump? Will you tighten with a wage jump? Will you tighten in a jam? Will you tighten, Sam I am? I mean, that's what we really want to know, is we want to know all these contingencies. You say you're so hawkish. Well, okay. But you were hawkish, you tightened 50 basis points, the market didn't do anything. That's not the impressive part. The impressive part to me is if you tighten and you don't care what happens to the market. That will be more impressive, and we haven't really gotten there. So those are the real questions, and we don't have those real answers. I have two fears at this point, and the Fed didn't allay either of those fears today. And one of those fears is that, and the market reaction, I think, highlights this. The stock market, as I said, didn't do very much until Powell said these magic words. In response to a question about whether the Fed, was thinking about 75 basis points, whether they would do a 75 basis point hike in the future, because the market had started to price that in for June, the possibility that they would hike 75 basis points. And Powell said a 75 basis point increase is not something the committee is actively considering. And at that point, the S&P jumped about 140 points over the balance of the session. Oh, that's super healthy, right? I mean, the difference of 25 basis points 1 month from now is worth 140 S&P points. What's that? Almost 3%. So this is my first fear. My first fear is that the market clearly cares more about financing and financing cheaply than it cares about organic growth. There is no reason that whether the Fed does 50 or 75 in June should be worth 3% to the S&P. That's just absurd. And I would even say that it shouldn't matter that much to the stock market, certainly to the companies that make up the stock market. It shouldn't matter very much whether or not the Fed's terminal interest rate is 3% or 4.5%. Okay, but it clearly does mean a whole lot to the value of equity shares. So whether or not it means anything to the companies and their earnings, it means a lot to the shares, because so much of what's going on in this economy is very, very levered, and it is contingent on that leverage being acquired at a really, really low interest rate. And so even a small hint that interest rates are going to go up less is a massively bullish thing for the market. That's not healthy. It's not a good thing to see. And that's one of my fears, because what happens in that circumstance is when you do take away that liquidity, when you do raise the price of that liquidity with the interest rate, and you do remove that liquidity by shrinking the balance sheet, then really bad things happen to markets. Now, I can argue that stock prices ought to be much lower anyway, in an equilibrium sense, but nobody wants it to get there in an ugly fashion. So that's sort of one of my fears, is that there's clearly this underlying shakiness, this jitteriness, this fragility when it comes to interest rates and liquidity that I don't think the Fed really appreciates, and I don't think that they can do a whole lot about it. It's something that has seeped into every aspect of our financial markets and many aspects of our economy, and it's just something that's going to be pretty ugly to unwind. And the second fear, I guess, is that I still don't think the Fed, I don't see any evidence that the Fed really understands inflation, understands the process. Powell says at one point, he says, our tools don't really work on supply shocks. Our tools work on demand. And when he was sort of talking about, whether or not the Fed can affect oil or food prices. Well, I mean, of course you can affect oil and energy and food prices. These are demand impacts here. And there's sort of this misunderstanding that I guess you can kind of go back to the whole transitory discussion, right? So when the Fed thought everything was transitory, they thought it was because there are these supply constraints that were happening, and that's why there were all these shortages. But they never understood, and they still don't seem to understand that the reason we had shortages was that we had this artificially created demand far in excess of the natural course of economic growth. But the government spending an enormous amount of money that the Fed printed created some false demand that is what caused the supply constraints. The massive increase in demand is what clogged the ports, not some inherent problem with the ports. And so, yes, energy prices are where they are because the economy is very, very hot. And the economy is very, very hot because the Fed has made it very, very hot, the Fed and the Treasury. And so, yeah, I mean, the whole point here is that if the Fed reduces the money supply, which I don't believe they have any interest in actually doing, but if they reduce their balance sheet enough and are able to reduce the money supply, then yeah, prices will go down, including oil prices, including food prices. So they don't seem to really understand that, and it's a concern. They kind of worship at the altar of interest rate hikes when it's really the balance sheet they should be paying attention to. It's not the cost of liquidity in the system. It's the liquidity in the system. It's the money in the system, not the cost of money that is really driving what's going on. And they don't seem to really understand that. And nothing that they have said as they've started to tighten kind of allays that fear for me. I do think that the Fed seems to be, they're being more hawkish so far than I had expected them to be. But they haven't yet been tested. So anyway, those are my fears, and Powell didn't do anything to allay them. As I said, I think it's unlikely that we don't have a recession next year, and I also think it's very unlikely that the Fed is going to keep shrinking the balance sheet if we get that recession or if the stock market drops. I guess one other comment. I read somewhere that the Fed put is dead. And the Fed put is the idea that if the stock market drops, the Fed comes riding to the rescue with more liquidity. And this idea got started a very long time ago in the 90s. And somebody wrote that, the market is down, and the Fed is not easing, so therefore the Fed put is dead. But that's just a ridiculous statement. The market is a grand total of 10% off the highs. Okay, so it's just barely a correction. I mean, we're not even in a bear market. And it hasn't been terribly sloppy on the way down. And I think if stock prices went down 15% and did it slowly and gradually, I can't imagine who would care about that. The Fed put doesn't mean that the Fed eases as long as stocks don't keep going up. The whole idea of a Fed put was if markets get sloppy and jittery, then that's when the Fed steps in. So anyway, the Fed put, I think, I have seen nothing that tells me that the Fed put is not there yet. And so all of these things will be revealed over the balance of this year. Is the Fed going to be more aggressive than I think? Are they going to pull back the liquidity more than I think? Are they going to ignore equity price declines? Are they going to be more aggressive when they see, wages continuing to go up? Are they going to be more aggressive as housing prices don't, suddenly decline, as used car prices, moderate the rate of growth but don't fall? Are they going to continue to be, aggressive in those circumstances? And I think the answer generally there is no. But we'll have to wait and see. But that's sort of the state of the world, the way I see it at the moment, and what that means for inflation is that we're not looking at going back to 2% in 2022 or in 2023. I think we're still on track for being in the 4 to 5% range for both of those years. So that's all for today's podcast. As always, you can contact me, Inflation Guy at enduringinvestments.com, or follow me on Twitter at inflation_guy. You can download the Inflation Guy app, visit Enduring Investments, follow my blog at mikeashton.wordpress.com. But most importantly, and even though the Fed is working hard, it's up to you. Defend your money. And if inflation is coming for you, remember, you know a guy.